Hello everyone, welcome back. In today's lesson, we will be discussing economic growth. Now, I want you to think, what does economic growth mean? And how can we measure economic growth? All right, so economic growth is the increase in the national output of an economy over a period of time. And when I am saying national, it means it is the country that we are talking about, the domestic country. Therefore, when I want to say how can we measure economic growth, we should be measuring it with something called GDP. GDP, it is gross domestic product. Let's take each word at a time. The word gross, it means total. Domestic, it's the national. It's within the boundaries or the borders of a certain country. And product, it is the output, the total production. So they measure economic growth through GDP. Let's define economic growth. What is it? What does it mean? When I'm talking about economic growth, it means the country, since this is one of the macroeconomic objectives, it means that the country that we're talking about is increasing its total output. So they are producing more. Okay, so it means we are having more production. Now, guys, remember, this is very good, but also, as we said in economics, we're never happy. This could lead to some disadvantages. The more growth we have in a country, it might lead to some disadvantages that we will learn about later on. Economic growth is when there is an increase in real output over time. So, for example, increased GDP and also national income. And now we'll see why the national income, the expenditure, and the output are related to each other. And it is measured by an increase in real GDP of an economy, and it is important as it increases the standard of living measurement of economic growth. So, for example, the more growth there is in a country, so the better the country is. When the country is better, it means we would be having more trade with other countries, so we would be exporting more, and at the same time, more money would come into the country. So obviously, the standard of living of the people would become better. Now this, you can find it. Now we are starting with the lesson. Before it was just an introduction. You will find this on page 319 on your books, and it is about measuring economic growth. Now, I want to measure economic growth in a country. I can do that. I can measure the total output in a country in 3 different ways. Okay, because the value of output should be equal to that of national income and to that of national expenditure. So I can choose whatever method that I would like. So remember this, it means they should be equal to each other, and they are different ways to measure total output in a country. So it's either this way, national output, national income, or national expenditure. Okay, let us have a look. An economy is made up from 3 people, and they have a $10 note. This $10 note is considered to be money supply. Now, 3 people and this economy, I am talking about a hypothetical economy, and it is a very simple economy that does not really exist. But I'm just trying to make it as simple as possible for now. Now, this $10 piece of paper is used to buy candles. So the transactions are as follows. If you take a look at that diagram, and this one you have it in your book, page 319, we have here the producer of candles, we have the butcher, and then we have the baker. So we're talking about 3 different people, remember? So we're talking mainly about the circular flow of income in this tiny economy. What does it demonstrate? What does it tell us? It's an important, it tells us about the value of output, about the expenditure, and about the income. Um, so the same relationship is true of all economies, no matter how large or complex they are. What is the relationship that we're talking about? It is that the national output would be equal to the national income, and it would be equal to national expenditure. Okay, this is why I can call it a circular flow of income or expenditure or output. Now, let me talk about let us see what's happening here. The producer of candles, he is making candles. He is producing the candles. This is his output. He sells it to the butcher. Okay. Um, in return, what did the butcher do? He paid money to the producer of candles. He gave him the $10. Okay? He gave him the $10, and I can say that this $10 has been used to produce the candle. Same thing happens between the butcher and the baker. And same thing would happen between the baker and the producer of candles. Okay? Um, Let's talk about the output method. What is the output method? This involves adding up the value of the output produced each period by every firm in every industry in an economy. However, only final outputs should be counted, otherwise the double counting of the value of some outputs can occur. So what do I mean by the final product or the final output? So for example, if I'm talking about the production of tables, what do I need? I need resources in order to produce the table, right? Wood. So wood would not be considered a part of my output. My table that is being sold is my final product. So here in that example that we're talking about, I'm talking about the value of the candle. And this candle, it was being sold for $10. Okay? Then I will be talking about the income method. This measures the total income earned from the production of goods and services within the economy. The figures provided break down this income into profits earned by companies and other business organizations, and even the wages and salaries of employees and the self-employed. Okay? So here also, when I'm talking about the income method, the producer, as we saw before, he received the $10 from the sale of the candles. So the producer of what? The producer of candlesticks, when he sold his candle to the butcher, he received $10. Also, the producer of the candles uses the $10 to buy meat from the butcher. He uses it to buy bread from the baker. So what's happening? Why do we call it a circular flow model? Because this piece of money, it is being circulated in my economy or in the economy. So the same $10 is being circulated 3 times in the same economy. The total value of the output is $30 because we were talking about the producer of the candles, the producer of the butcher, and that of a baker. Now, what do I mean by talking about the expenditure? Expenditure, it means I'm talking about the spending. So when I'm talking about spending, it means the money spent, which in that scenario, it is the $10 to buy the candles. So when the butcher bought the candles from the producer of candlesticks, and he paid $10. So again, I will re-explain. Most goods and services produced, what happens to them? They should be sold. Okay? The value of output can therefore be measured by adding up the total amount spent on all final goods and services produced in an economy. This would include the spending, okay, the spending. So this is a summary. You need to know 3 different ways to measure the output. So it could be either national output, and it should be equal to national expenditure. It should be equal to national income. So they produced goods worth of $10, meat worth of $10. When I buy them, it means I spent money on it. I buy it also for $10. I buy the meat that was being produced for $10. And national income, this money that I paid, the $10, it is an income, which is the money of 10, which was $10. Okay, so another way, for when I want to talk about national output, factors of production are used to produce national output. Remember, we cannot produce a good without using resources. And then we have national expenditure. We pay for what we buy. So what are we doing? We are spending. Income to owners, which help to buy the output. And then finally, we have the national income, which is the total amount of income earned by factors of production. Now, guys, this is page 320, and our objective would be distinguish between a GDP and GDP per head or per capita. Sorry, per capita. Gross domestic product is the main measure of total value of all goods and services produced in a given period of time. But let's forget about this the definition. Let me say GDP of a country. It is the monetary value of all goods and services produced in a country. Why did I stress on the term monetary? Because you learned this in math from grade 2. You cannot add apples and bananas together. So same thing is happening here. If the country is producing, for example, bread, also if the country is producing, let's say, oil, if the country is producing dates, if the country is producing cars, they're producing all of these. This is called their output. I cannot add them all together. So what I do, I say the monetary value of cars being produced. So let's say this would be 1 billion dirhams. Okay, a bread, whatever dirhams it is, oil, same thing, and dates, same thing. I add them all up, and I would be getting the monetary value. That would be my GDP. Okay, now an increase in prices, it will increase the nominal GDP, but this is measured in current dollars or dirhams, thus it includes inflation. Now we'll explain the difference between real and nominal GDP. This is the formula. I would like you to write it down, but remember I did not explain the difference yet, so just wait. So this slide will help you understand the difference between nominal GDP and real GDP. But before we start explaining that, I need you to know what is meant by gross domestic product or GDP. Guys, if you get this as an external question, and it would be define a GDP, and usually the defined questions are out of 2 marks, you are not allowed to say that it stands for gross domestic product. You will not get the marks. What you are supposed to say is it is that it measures the monetary value of the output produced in an economy over a certain period of time. So monetary value of output produced in an economy over a period of time, then you will get the 2 marks. Now let's have a look at this image first. so I can explain nominal GDP. And please listen to the explanation. In the last year, the nominal GDP of a country was $100 billion. In the current year, which is year two, it has increased to $110 billion, as you can see. The price inflation was 10% over the same period. This means all of the increase in the nominal GDP is explained by the rise in general level of prices. So there was no increase here in the real GDP. So inflation was 10%, and there has been no change in real GDP. Look, there has been no change in the output. So they did not take into consideration the volume of goods and services produced. It stayed on the same level. Look at what I'm drawing here. Okay, same level of production. So it was only an increase in price. This is why usually the nominal GDP values are greater than that of the real GDP. But this is not what we use. If we want actual figures, we are supposed to take the real GDP into consideration since it is adjusted for inflation. So let's have a look. Let me explain this second image with a different color. I will be explaining it in green. Here, same given. So the GDP in year one was $100 billion. In year two, it increased to $110 billion, right? If the price inflation had been, let's say, 7% over the same 12-month period, then 7 billion of the increase in nominal GDP would have been simply due to rising prices. The other 3 billion therefore would have been due to an increase in the real output of firms in the economy. So what's happening here? Inflation was only 3%. So there has been a 7% increase in real GDP. Okay? So this is why before when I wrote the formula for real GDP, now it could be applicable. So when I want to calculate real GDP, it would be nominal GDP divided by either the CPI, which we will explain it in the next unit, which is Consumer Price Index, or I'd say the deflator, and I multiply that by 100. Okay? Now I need you to know that GDP is two different kinds. We will be talking about the real GDP and the nominal GDP. Now, what is the difference between them? Whenever I am talking about nominal GDP, it is GDP at current prices. That is not adjusted for inflation. Whereas the real GDP, it's at constant prices that is adjusted for inflation. So constant prices, and they are adjusted for inflation. Now, when I am talking about the real GDP, it can be separated. GDP in general, it could be separated into 3 parts, as we said at the beginning of the lesson. So GDP, G stands for gross, which is total. D, domestic, which refers to the geographical boundaries of a country. And product, it means the output. But also, I have 3 methods to measure this output. And I have something called either the output method, which adds up all the output produced in a country. So this would be the first one. It's self-explanatory. It's measuring the output. Then the second method would be called the expenditure method, which adds up all the spending on a country's finished output. So they're taking into consideration the finished products, and they are adding how much they're spending in order to make these finished products in a country. And finally, I have the income method, which means they are adding up all the incomes that have been earned in producing a country's output. Now, all 3 methods will produce the same figure. So if I calculated the GDP using the output method, measured the GDP using the output method, and I got $2 billion. Also, if I use the expenditure method, I would be getting 2 billion. Or if I use my income method, I would also get the same figure, which is $2 billion. Okay? This is because an output of a certain amount will give rise to an income of the same amount, and this income will be the expenditure on buying the output which is produced. Now, GDP is first calculated in nominal terms, okay? And this nominal GDP can also be referred to as money GDP or GDP at current prices, as we mentioned earlier. It has not been adjusted for inflation. It is therefore necessary to adjust the nominal GDP to take account of inflation in an economy. So the nominal GDP is therefore adjusted to take out the effects of inflation, and this is called the real GDP. So I cannot, you might be wondering, then why would a country be using two different GDPs if uh, the most effective way is using the real GDP? It is because I cannot find the real GDP if I did not find the nominal first. So nominal GDP is therefore adjusted to take out the effects of inflation, and this would be called my real GDP. This gives a figure for GDP at constant prices. Now, also, this is another explanation for the difference between a real GDP and nominal GDP. When I'm talking about real GDP, I'm taking the growth into consideration. So as you can see in the previous slide, there were more boxes produced in year 2. Whereas in the nominal, the prices are increasing, but they are not taking the increase in output into consideration. And this is why the nominal GDP, we said it is greater than that of real GDP. So I wrote down a summary. Real GDP, it measures an economy's total goods and services in a given year, taking into account changes in the price levels. Also, it allows you to compare GDP by the year because it takes into account inflation. So as we said, the real GDP, it is adjusted for inflation, whereas the nominal GDP, it is not. Also, it is a good indicator of where the economy is in the business cycle. So it tells us about the economy. Is the economy facing growth? Is it facing a recession? So it gives us a good hint. Knowing the real GDP, this one, it can help us also, since it's related to the business cycle, it can help us know when we will be expecting a recession. And as we all know, recession is something that is bad. Okay, so we should be well prepared for it. We should know what policy the economy should use or the government should use in order to avoid a recession. I'm sorry. Nominal GDP, this one, it includes both prices and growth, while the real GDP is only pure growth. So it's what nominal GDP would have been if there were no price changes from the base year. And this is why, as we explained before, nominal GDP would be higher. This is a pure summary. You can find it in your books on page 321 and 322. I made it in a table form again. So this is like the difference between nominal and a real GDP. Please, I would like you to pause the video, read it by yourself since it is a repetition of what I just explained. And please try to write it down on your copybooks. Yeah? Now, why governments use GDP statistics? This could be found on your books, page 322. So, in general, GDP statistics can help governments and economists in a number of ways. The first way is the allocation of resources. What does that mean? So, when I am talking about resource allocation, Let's say, for example, if a government thinks its economy is producing too many consumer goods and too few capital goods, so they are producing more consumer goods than capital goods, it may try to encourage the production of capital equipment through higher taxes on consumer goods and lowering taxes on the profits of machinery and equipment manufacturers. So it helps us to know what is the best decision on economic policies that will affect our resource allocation and production. So how to use our resources in the most efficient way. Two, the second reason why governments use GDP statistics, it is because they would be comparing the standard of living in one year compared with the next year. So if the amount of goods and services produced in an economy has increased over time, we might assume many people are better off. And let's say if the amount of goods and services produced in an economy has decreased over time, what does this tell you about the standard of living of people? That it is becoming lower. Finally, they would want to compare standards of living between countries, or even it could be in different areas of the same country if we're talking about a big country. So how can they do that? They want to find the average income of each person. How do we find this? We can call this average income of each person, or I will call it a GDP per capita. So how do I calculate it? It would be GDP over the population. What does that mean? If the average income is high in a certain country, this tells you that this country is experiencing high standards of living. Okay, so for instance, let's say I'm talking about a very small and simple economy that consists of three people. The first person, his income is $10,000 per year. The second person is $20,000 per year, and the third person, it is $30,000 per year. I want to see on average each person what is his income. So what we do is we add up all the income that they are getting, which is 10 plus 20 plus 30. It would give us a total of $60,000 divided by the population. My population in that example would be 3. So on average, each person is getting $20,000 per year as an income. So that's it for today's lesson. In my next video, I will be talking about policies to promote economic growth. And we will be talking about business cycles and what happens during a recession and how does that affect our production possibility curve. Don't forget to subscribe in order to view next videos. Thank you and have a lovely day.